This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the New York pre-market. Now, let's get into it. As of 9:19 ET, the S&P 500 is tracking a minus 0.99% decline at $743.29, but the real fracture is happening inside the Nasdaq 100. QQQ is down minus 1.5% at $695.33, sitting precariously close to a critical structural floor. We're seeing a violent rotation away from growth and into energy, with the VIX jumping 2.4 points to 18.77. Let's break down what the data tells us right now. First, let's look at the schedule. For today's Monday, July 20, 2026, we don't have any major macroeconomic releases or central bank decisions on the calendar. However, the earnings window is active. We have AGNC reporting with an earnings per share estimate of $0.38, BOCF at $2.56, and CCK at $2.15. There are no S&P 500 heavyweight earnings today, meaning the market's direction will be driven almost entirely by this sector rotation and the technical breakdown in the QQQ, rather than individual company surprises.
And with that lack of idiosyncratic catalysts from the index components, the absence of big earnings becomes the catalyst itself. The market is forced to react purely to the macro regime shift we're seeing, specifically that flattening 10-year to year spread and the sticky inflation print. We aren't looking at a bad day. We're looking at a structural derating of multiple heavy assets because the yield environment is punishing them.
That brings us to the headline picture. As of our verified price data, the S&P 500 is at $743.29, the Dow Jones Industrial Average is at $520.81, and the Russell 2000 is at $294.04. But the story is in the sector ETFs. Energy is the sole green patch at $57.68, up plus 1.16%. Meanwhile, communication services are down minus 1.78% at $110.65, and consumer discretionary is off minus 1.62% at $115.44. Technology, as measured by the technology sector, has taken a massive minus 5.48% hit this week. Pulse, walk me through what this looks like in terms of sentiment versus price action. Looks like a classic distribution phase masked by retail optimism. Here is the divergence. NVDA has 69 articles with a bullish sentiment score of plus 0.42, and Google is holding a plus 0.6 sentiment score. Yet QQQ, the vehicle for both, is down minus 1.5%. This isn't a buy-the-dip signal, it's institutional exit. The bullish news flow is acting as liquidity for sellers. Meanwhile, the VIX has spiked to 18.77, pushing us dangerously close to that 20-level psychological barrier. The crowd is reading the headlines, but the money is flowing into the energy sector and staying away from the technology sector.
And on the charts, Grid sees that bullish headline narrative completely failing to hold up against the tape. QQQ is currently at $695.33, which is less than 1.3% away from its 10-day low of $686.76. That is a technical cliff. We are seeing heavy volume on the losers. Names like FNGA and JGGC are pushing over 6 million shares. That is not retail noise, that is institutional distribution. The structure is broken. Any bounce toward the Friday high of $702.30 is going to hit a wall of supply, just like it did at SPY's $747.29 resistance earlier in the week.
So we have a technical breakdown coinciding with a sentiment trap. CIPHER, let's dig into the fundamentals behind this. We saw DPZ gap up plus 6.9% to $344.40 on strong Q2 revenue, and AMD is up plus 4.7% to $518.98 on TSMC news. Are these justified, or is it just noise in a rotting sector?
DPZ is a quality play within a defensive sector. It's maintaining margins despite the consumer staples pullback. That's valid. But AMD, the fundamental anchor here is the supply-side expansion in Arizona. However, you have to look at the broader AI infrastructure trade. Micron Mu is up plus 4% to $882.61, and Seagate, SDX, is up plus 3.9% to $818. These are the names benefiting from the physical build-out, whereas the pure-play software and speculative growth names are getting crushed. The fundamental disconnection is clear. Investors are fleeing the promise of AI returns, high multiples, and bidding up the reality of AI capex, tangible assets. The technology sector collapse isn't just technical, it's a repricing of earnings visibility in a higher-for-longer rate environment.
SPECTER, this rotation into energy and staples feels like a defensive moat. But is there a risk that this flight to quality gets crowded, or is there a deeper structural flaw in the macro setup that threatens even these hedges?
The flaw is the yield curve. The 10-year 2-year spread is flattened at just plus 0.37 pp. That's 4.57% versus 4.16%. Historically, that flattening precedes growth slowdowns, which explains the minus 5.48% drag on the technology sector. But here is the risk. If the VIX breaks 20, liquidity dries up across the board. We are currently in a soft landing risk-off scenario, but with core PCE stuck at 3.41% and CPI at 3.46%, the Fed has zero room to cut. The energy sector's strength is not a sign of health. It's a desperate bid for safety in a system where real yields are becoming hostile to equity multiples. If we lose the $740.80 support on SPY, we aren't just correcting. We are entering a liquidity vacuum.
Let's get specific on the assets under fire. First, QQQ. It is at $695.33. Grid, you identified the $686.76 low as the line in the sand. What happens if we tag that number?
If QQQ tags $686.76, the short-term uptrend defined by the last 5 days is invalidated. We open the door to the 10-day low range, but more importantly, look at the resistance overhead. $702.30 is the Friday high, until price can reclaim that with volume, every dollar gained is a sale opportunity. The technical structure is heavily skewed to the downside. We are not seeing consolidation, we are seeing a slow bleed toward support.
And that bleed is accelerating because of the cross-asset correlation. Grid, you're watching QQQ, but Pulse pointed out the sentiment decay in NVDA and MSFT. The technical breakdown in QQQ is being validated by the fundamental refusal of megacap tech to hold gains despite positive news. It's a synchronized sell-off.
Let's talk about the defensive side of the ledger. The energy sector is up plus 1.16% to $57.68. It is the only green sector in the table. SPECTER, you mentioned this is a desperate bid for safety. Does the energy sector have room to run, or is it fully valued given the macro backdrop?
It's fully valued as a hedge. Look at the 24-hour high for the energy sector. It's essentially grinding higher as risk assets dump. But don't mistake this for growth. It's a store of value. If the VIX spikes toward 20, capital will flood out of communication services and consumer discretionary and settle here. The risk is that once the panic in tech subsides, or if bond yields spike further, the energy sector might see profit taking. But for now, it is the only ballast in the ship.
CIPHER, does the fundamental case for the energy sector hold up against the broader market's earnings reality? Or is it just a sector play without the same earnings tailwinds we saw in DPZ?
It's a yield play, not a growth play. The energy sector outperformance is directly correlated with the underperformance of consumer discretionary, minus 1.62%, and the technology sector, minus 5.48%. When the 10-year yield is at 4.57%, companies with stable cash flows and tangible assets, energy, become more attractive than companies needing to issue debt to fund future growth, tech. So yes, the energy sector is supported, but it's supported by the pain in the other sectors. It's a relative value arbitrage, not an absolute bull case.
Finally, let's look at the small cap indicator, the IWM. It's at $294.04, down minus 0.52%. It's outperforming the QQQ percentage-wise, but is it truly safe? Apex synthesized the view on the breadth of this decline.
It's a mirage of safety. IWM is down minus 0.52%, while QQQ is down minus 1.5%. On paper, small caps look resilient, but look at the director's brief data. The volume on speculative washouts is high. The IWM is being propped up only because the heavyweights in the S&P 500, SPY at $743.29, are dragging the average down. Once the broader market finds a bottom, the relative weakness in IWM will emerge. The 10-day range for IWM is $290.68 to $300.41. We are mid-range. But remember, the 10-year 2-year spread flattening hurts small caps disproportionately because they rely more on floating rate debt. If that spread widens negatively, IWM is the first to crack.
So, to summarize the state of play as of 9/19 ET, the market is experiencing a structural rotation. Tech and growth are being dumped due to valuation pressure and a flattening yield curve, while energy and staples are absorbing the flight to quality capital. QQQ is testing a critical technical low at $686.76, and the VIX is expanding toward 20. There are no major earnings today to disrupt this flow, so the technical and macro factors are driving the price action. We'll monitor how the $740.80 support on SPY holds up and whether QQQ can reclaim $702.30. Thank you for listening to the ShadowQuant Equities edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.